Okay, so I wanted to provide a quick update on the Korean stock market because, first of all, they're down almost 20% this week and down now about 40% off the top. So it helps provide a bit of context into what's going on at the moment. But also, I think it's a good opportunity to look at this as a bit of a case study of something that's basically gone right, as a sort of a warning call that I'd issued a couple of months ago for clients. And it's a good opportunity to basically go through process and framework and kind of show you a worked example of how I approach things here at Top Down Charts. So first of all here, what you've got is basically the main page that you see in the report that I put out each week. And so you've got there down the bottom an explicit score or rating for each of the 5 factors that I look at. So for valuations, that's basically whether things are cheap or expensive. And so the objective there is to provide some kind of objective basis or indicator for making that assessment. And yeah, as you see there, Korean equities were showing up as expensive. We'll show you the chart on that. I might as well look at it right now. The valuation indicated there had gone up to basically dot-com bubble levels. That's classic bubble kind of territory there. But the next step is looking at the macro fundamentals, and so that's different for every market or asset that you're looking at. It's different for commodities, bonds, stocks, different for different stock markets. For Korea, the AI side of things was, maybe still is, probably still is good. Good things going on there, but the sort of macro side of things, inflation risk was basically starting to heat up. And so that's what takes you there also into monetary policy side of things, or monetary/policy. So this talks about things like, just plain and simple rate hikes versus rate cuts, general monetary policy settings, and then also fiscal policy. So if we jump forward to the macro slide here, this is a key part of the puzzle for what's going on in Korea. Why now? Because, we often see setups where it is expensive and, positioning is very crowded and, ultimately that will kind of sort itself out. But, in the interim time, things can keep on going up further and faster than you expect. So there needs to be some kind of catalyst. And I do specifically talk about that. So just to also sort of dwell on the report structure here, I provide the assessment. So this was from about a month ago. Korean equities are at risk after a near vertical run. Extreme expensive valuations, particularly as policy is about to pivot to rate hikes and having made an initial breakdown, which they had done so at the time. And so the risks there is basically the risk that this view would be wrong. So, normally it's more sort of, naturally fitting as a risk when it's a bullish call. But the risk to the view of basically a bearish call on, or flagging downside risk here, is that the market actually was correctly excessively optimistic about the AI new paradigm, and new follow through fundamentals, etc. But again, on the catalyst, what are the downside catalysts there? The inflation surge prompting policy tightening that can pop the bubble. Because, if policy is supportive for a long time and then you kick into rate hikes, that can, have a sort of butterfly effect there, as it seems to be having. Or, the other point there is the AI enthusiasm starts to wane, which, my sense is that that's also happening. If you look at what's going on sort of globally, and then, competitor breakthroughs, which are sort of a more stock-specific kind of thing. But going back to the macro page here, so we've got a picture of interest rates there on the left, and the black line there, I've actually updated a couple of these charts. I've updated this one. So the Bank of Korea did actually kick off their rate hiking cycle, and I think that is a key reason why things are really sort of starting to unravel there. Because, if you take that to its logical conclusion, especially you look at the inflation indicators there, producer prices surging, house prices have been surging as well, and then your core actual inflation measures moving up from an already, high level relatively to where it had been. And even just looking at the 10-year there for Korea had already gone up to the upper end of the range. Risk is that it, punches through that and keeps on moving higher. That again, higher interest rates are poison for the stock market because for a few reasons. But the biggest one is just it changes your calculations that you make. If the interest rate goes up enough, then you think, well, do I just take the risk-free rate and sleep calmly at night, or do I sit in the stock market, which could go down 11% as it is kind of at the moment, the last time I checked. But back to the framework picture there, that sort of fills out that bit there, and then moving over to sentiment and positioning. So again, what we're trying to do with this framework is build up basically a puzzle picture, and so you're trying to find as many different pieces of the puzzle as you can, and that helps you have a greater chance of understanding what is the picture here. And also, when it comes time to actually making some kind of call, that then it also raises your conviction level if you have all the puzzle pieces saying the same thing. And obviously conviction level matters immensely because it impacts your position sizing and whether you take the position at all. But sentiment positioning, that's kind of your behavioural aspect, and so that will include things like surveys, positioning indicators, so futures positioning, for example, or allocation, actual allocation information. Basically, the idea there is to get the mood of the market, and so if you take it simplistically, it's either extremely optimistic or extremely pessimistic and panicking, and that's generally contrarian information. Through the range, it can be momentum. If you're going from excess panic, pessimism up into optimism, that can actually be bullish. But it's when you get to extreme optimism, and then that's where the way I describe it is that there's a lot of minds that can change, given the right reason. And so, what we're seeing in Korea basically at the moment is all those minds that were made up on the bull story there, they're starting to change and all change at once. And then lastly, you round that all out with the technicals. And so technicals is, the way I like to kind of describe this framework is that you can either start on the valuation end, you look at something that's expensive, you build up the rest of the picture, and then you use technicals to kind of, basically time the thing. Or you can take it in reverse, where you say, oh, here goes a market where something technically is interesting, it's breaking out. What is the valuation picture, the fundamentals, sentiment, etc. And so this is kind of one of those rare setups where everything was all basically in the same direction, except for, of course, the AI story kind of side of things, which I think was already well understood and more than factored in. And that's probably a good time to jump to the last set of charts on this one, which shows you the unfathomable surge in forward earnings there and the long-term earnings growth estimates. You've probably seen the USA version of that chart, and I've included it there, which it does look extreme, but then it's on a whole different level for Korea. Basically, this is new paradigm stuff here, and they probably are going to have good earnings growth, and there are good things going on. There is a lot of demand for chips, but the thing that I would highlight is when you look at forward earnings, and this has been one of the things that where I've got pushback on this is oh well, actually the forward PE ratio is cheap, and back at the top there the forward PE ratio was looking cheap. But the thing you need to remember is that forward earnings estimates is, well, yes, they do reflect improved fundamentals and an analyst's expectations of all those things that you'd expect them to be factoring in. But when price runs up a lot, what you can end up seeing is that rather than the analysts sitting down and figuring out what earnings growth should be and then therefore making their price target based on that, is they'll have a position on the stock, I'm bullish on Hynex or whatever, and therefore if you're bullish on it, your target price has to be higher than the current price, right? Otherwise, technically, you're bearish. And so to work that out, the maths there, you basically have to fiddle around with your discounted cash flows so that your earnings become a balancing factor. And of course, if you expect the price to be higher than it is right now, then to balance that out, you have to basically increase your expectation of earnings. And so therefore, what you actually see is that there's a big correlation between forward earnings growth and the stock price growth. And yet, in normal markets, that makes sense because the stock price is generally going to go up when earnings go up, and if everything's kind of all normal, then that makes sense. But when you get into a bubble market where expectations get a bit carried away and everybody's piling in and speculation's going crazy, and the South Koreans love to speculate, then that's when you get basically this kind of crazy runaway earnings growth expectations here, which we're seeing here. And so, on first glance, you might think, well, this is actually quite a bullish story, and at the right price, it will be a bullish story. But it's also actually a sentiment story here, which again just highlights the fact that things did get carried away. We saw also on the positioning side of things, basically a massive rotation out of China and India and into Korea there. Typically US equity ETF investors had been running around a 10% allocation to Korea, and then that went up 3 times. And so that's just one of many indicators. We've also seen margin debt move to really extreme levels, beyond .com levels for Korea, and that's also one reason why we're seeing such a sharp and serious sell-off there. But yeah, so to sort of summarize here, basically it was the perfect storm, or the perfect kind of risk setup here. The valuations were expensive, inflation risk was rising, policy was about to kick into rate hikes, and sentiment positioning was way too optimistic. And then you got that technical confirmation from the initial breakdown there. And so, from a framework standpoint, as a case study, this is a good way to kind of understand how I do things, and you can probably learn that and you steal bits from that to improve your own way of looking at things. But also kind of good to just check in and see what's going on with why we're seeing such carnage there. And I guess the next question would be, well, what's next? When would you flip that view? Well, if you're respecting that same framework, you would be looking for valuations to get cheap. We've seen a big reset there, but we're not at cheap levels. You'd want to see positioning get all shaken out as well. You'd want that inflation problem to kind of get under control as well, and that's going to take time. And policy is into its tightening phase. Maybe stock market volatility will kind of hold their hand a bit, stay their hand a bit there, but in the meantime they've still got the inflation problem. The earnings side of things, if that comes through as expected, ultimately that will, because ultimately for stock markets, the things that make them go up over the long term is earnings. But again, you've got to have the right price for that, which again I don't think we're there yet. So I would say, it's we've come a long way already, but we may still need to see a bit further adjustment there yet. So that's it. If you found this interesting, be sure to give a like and subscribe, and stay tuned for more updates.